Hi, my name is Jim and I was retired. I had planned to follow up on my last video on the cold, hard truths on inflation with a little bit more about how to deal with it. But now in the last few days, we've seen the prospects of another European land war. These are scary times, and stay tuned to this video and I'm going to cover both topics with what to do about it. These are scary times, and many retirees want to know what to do about it. Well, I'm going to tell you what I'm doing. It may not work for you, but it may give you some ideas on how to manage the stresses that we're facing right now with inflation and the prospects of war. Inflation is running very hot at levels we have not seen for 40 years. The Bureau of Labor Statistics put out its number of the Consumer Price Index, and it was 7.5% on an annual basis in January. On Friday, February 25th, the Bureau of Economic Analysis put out its number of the Personal Consumption Expenditures, PCE, price index. And that's the Fed's preferred measure of inflation. And it's 6.1%. Now, a quick explanation on these two measures of inflation. The more popular CPI measures what the average urban worker would buy in a basket of goods each month, and it's very specific on those goods. Whereas the Bureau of Economic Analysis PCE number is based on consumer spending categories, and it looks at what all consumers, businesses, and nonprofits spend on consumer spending in a month. That's a broader measure, not just urban workers. And for retirees, it's also helpful to look at that number because it includes a higher percentage of health care than the CPI basket does. Again, it's running at 6.1%, and generally the PCE will run about a half point lower than the CPI, as this chart shows. Now, I'll put links to several articles for anybody who wants to geek out on inflation measures. Check on the notes below and you'll see some background on these inflation measures. As we discussed in the last video, I'm in the camp of Milton Friedman, who said that inflation is always and everywhere a monetary phenomenon. So no matter how you measure that inflation rate, it's too high, and the only people who can take action to solve it is the Federal Reserve, the central bank. One viewer of my last video appreciated the background but wanted to know, what am I going to do about it? Well, I'm not the Fed, so not much. Now, in the last few days, we've all witnessed Russian tanks rolling into Ukraine, and markets are in turmoil as there's fear of higher energy costs and a rush to the securities of safe investments like treasuries. What am I going to do about that? Again, not much. There's not much a DIY retiree can do about war and inflation, except do what you can. I'm reminded by a famous quote by John Bogle or President Dwight Eisenhower or Adlai Stevenson or the White Rabbit in Alice in Wonderland. Yes, all of them are attributed with this following quote. All of those folks offer the sage advice instead of the more popular, panicky, don't just stand there, do something. They all offer the advice, don't just do something, stand there. Many times, any action that we take ends up to be the wrong action. And it's better to pause, wait, and follow your strategy. And that's exactly what I am doing. So I manage my unexpected retirement in a do-it-yourself retirement strategy that, as we've talked before, includes 3 time buckets and 3 tax buckets. And I manage the assets over that to handle unexpected risks. For instance, in March 2020, the great unknown was COVID-19, and the market took a terrible dip. A little mini recession. Many people panicked and sold equities into that down market. I didn't. I knew my bucket strategy worked, and I had enough cash on hand to handle 3 years worth of expenses. So I let my equities, my long-term investments, ride, and they recovered more than enough in the year. Now, we're experiencing a down market right now. There's been a pullback of about 10%. I haven't changed my risk profile, and instead, I actually have a little cash cushion right now. I balanced out my time buckets at the beginning of this year, so I'm sitting at about 10% cash in my total asset portfolio. I want to get that down to about 7% by the end of the year, as I go from about a 50-50 split right now to a 60-40 split by the end of this year. So I have cash, and on a market pullback, I have opportunities to buy equity at the better prices. So that's what I will do. That's one thing I can focus on. I can't solve inflation, I can't solve war, but I can focus on doing that to match what I expect my portfolio to look like at the end of the year. The other thing that I can focus on are expenses. And as we've discussed, I am phasing out my 2 actively managed Vanguard funds, Wellesley Income and Wellington, in favor of low-cost index funds. And I'll continue that strategy in my quarterly rebalancing of the portfolio this year as I move towards that asset allocation that I have chosen. Now, I don't know what inflation or war is going to do to my portfolio value, but I do know I'm going to save hundreds of dollars by lowering the expense ratio on my investments. And that'll be hundreds of dollars each year, so it will add up. More importantly, focusing on those things I can control gives me some peace of mind. Now, under no circumstances am I going to sell my equity in a down market. That's why I have a bucket strategy. So I'm not going to panic. I'm going to, in the words of John Bogle or that white rabbit, just stand there. On inflation, I'm also standing there with my conservative 3% long-range estimate of inflation. Again, I began retirement at about 2%, but I've moved it up to 3% to be a little bit more conservative. And I'm not going to go any higher. I'm going to wait to see what the Fed does in the coming weeks. In January, the Federal Open Market Committee, or FOMC, which is the group of policymakers within the Fed that set monetary policy, reaffirmed their inflation target of an average of 2% PCE inflation, and I'm going to see if they stick to it. They are clearly over that 2% inflation target right now if PCE inflation is running at 6.1% all in. Even if you strip out food and energy, it's around 5.2%. It's still clearly higher than the 2% target. So what are they going to do about it? Milton Friedman says they're the ones that need to address inflation. The actions that the Fed takes in the coming weeks will determine whether the consumer has confidence in the Fed to set monetary policy. Inflation expectations have been anchored at that 2.5% level for a long time. They've anchored those expectations because they've come to expect that that's where inflation will stay. If the public does not view that commitment to a systematic monetary policy with an inflation target as real, then those expectations are going to come unanchored. And we're going to see a cycle of higher and higher inflation expectations that lead to more inflation. That's a bad recipe for the economy. The last time that happened, it took 2 recessions and Paul Volcker raising the rate to 20% to break the back of inflation. We don't want to go through that again. While some Fed watchers may expect shock and awe in March with the Fed raising rates by 0.5 point or more, I don't really expect that. Recent history suggests that the Fed will raise rates by 1/4 point increments. Now, the Fed is very ready to drop the rate rapidly to respond to a shock, as they did with the COVID shock in 2020. The FOMC dropped the Fed funds target rate to near zero to respond to COVID-19 in March of 2020. But the last time the FOMC tightened monetary policy from 2017 through 2018, the committee did it in 1/4 points steady rates. And I think that's what we're going to expect. Right now, the FOMC voting members include 4 Fed governors and 4 Fed presidents due to some vacancies. And it'll be important to see in the coming weeks how those 8 policymakers decide to take action. This will also be one of the 4 meetings of the year where all of the Fed policymakers, including the non-voting presidents, submit their estimates of measures of the economy and the proper path of monetary policy. It's known as a summary of economic projections, and it will include a dot chart like this one that will give us an indication of how those policymakers expect policy to unfold in the coming few years. That'll be an important judge of how many rate increases we can expect this year and next to get us to that 2% average PCE inflation. If they do it, then we're all good. If they don't, we're going to have to raise our expectations of inflation. The other unknown is the policymakers themselves. There's a new president in Boston who will begin voting in July, and there's another president in Dallas that is yet to be selected. And President Biden has 3 governors under review by the U.S. Senate right now. I hope incoming policymakers share this commitment to a systematic monetary policy, and none of them are fans of that crazy idea of modern monetary theory that some of the progressive left favor. That is the policy that Venezuela and other countries use. Hopefully, we're not going to go down that path, but instead stay on a path that will lead to stable inflation over time. Easy monetary policy leads to inflation, and only tighter monetary policy can solve it. I'll conclude with my standard word of warning. I am not an economist. I am not a financial planner. I have no special initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. And be sure to subscribe, like, and hit the bell notification so that you'll get notified when I do my next video. Thanks.